This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Luke back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Luke's picture saying, looking for the downloads. Okay, Eric, what are your thoughts here on equities?
Well, Patrick, the rally has been quite impressive, needless to say, and there are plenty of fundamental arguments that you could make to explain why we could be headed back toward all-time highs. But the fact remains that we're still below, only a little bit below, the 50-day moving average in a market that is learning to cope with White House policy uncertainty, including sudden and large important policy change announcements with no advance warning or hint as to what's coming. Now, that could mean the risk of tail events on either side, both big moves up or big moves down. So I see plenty of good arguments for why we could get new all-time highs in the next few weeks, and I can also imagine plenty of scenarios that take us down to 3,000 on the S&P in a week. So frankly, I don't have a lot of strong directional conviction other than vol trades are the place to be here. What I am delighted to say is that I was filled just about an hour or two before recording time on the final tranche of my hedge position, so I'm now fully hedged in case we're about to take a turn south. I'm not predicting that's happening. It's been several weeks now, though, since the Trump administration hit the market with a 1,000-point downside curveball. So I suppose maybe we're overdue for the next one. On the other hand, that next curveball could be an upside curveball. So let's wait and see what happens. As Lynn Alden said, it is a headline-driven market. So I think where the market goes next will depend in large part on what the next headline says.
Well, Eric, I do think that there are downside risks, and Trump will continue to be a factor moving forward. But I do believe that if we do see that kind of downside that you're talking about on the markets, it is going to be far more about whether or not the indications are that we are moving toward a U.S. economic recession, and therefore something that impacts corporate earnings and can see corporate earnings contractions, which is usually something that is needed for there to be a bigger and deeper bear market. So what are those recession risks? Well, I do like looking at the poly markets, betting markets for U.S. recession risks, because that's where people are voting with real money. And we have that now at a 66% chance of a U.S. recession after that advanced GDP number was released. And so recession risks are growing, and that is why things like the jobs numbers coming out tomorrow are going to be really important. Are there going to be continued indications that we're moving towards that economic recession? Now, on page 3, I have that chart of the S&P 500, and we can see now that we've gotten to that 50-day moving average, and we've now entered the Fibonacci retracement zones of the prior decline. Now, on the short-term reactions to the Mag 7 earnings will drive flows for the next couple of trading sessions. But the bigger puzzle to solve is this a bear market rally? Because if this is a bear market rally, we shouldn't see much progress beyond, let's say, 5,700 or 5,800 on the upside. And so the question here is that will we in the coming weeks see overhead resistance? The FOMC meeting coming up next week will also play a key role, because right now the Fed has continued to focus more on inflation risks and has not made a dovish pivot, which I think if we see the tone of our concern come from the FOMC that somehow the market risks are growing and that they're going to have to tilt dovishly moving forward, that is going to be, I feel, a big factor that could drive the next major market move. To me, the asymmetry is completely skewed against the bulls. There's arguably a limited upside potential, though the trend can continue, but limited upside potential with a lot of things that can go wrong off these levels. And so to me, lightening up into this strength is a prudent thing. All right, Eric, let's move on to the U.S. dollar index.
Well, I guess the most bullish thing we can say is the dollar index is holding up 99 this week. I don't know what else to say other than we're overdue for a dead cat bounce, and maybe there's good reason to expect one sometime soon. 100 was an important psychological level on the Dixie, so whether or not we stay below it now that we are below it will be an important tell for whether or not a relief rally is in the works. I remain strongly of the view that the dollar will keep falling until it falls as far as Trump and Bessent want it to, and I suspect that that number is a lot lower than 100.
Well, on page 4, I have that dollar index chart, and we did definitely break last year's lows on the downside, which is really making the downtrend of the U.S. dollar the predominant one. But we are very oversold on the dollar and looking for it to retrace, maybe even back to 101 or 102 temporarily, just to unwind the oversold state, is still the path of least resistance. We talked about it last week's show, and I still think this is the path of short-term least resistance. But if we see that the dollar bounce is very weak, it fails to follow through, making no real progress above there, staying below the 50-day moving average, then maybe later in the month of May or even early June, we could see the U.S. dollar resume its bearish downtrend. And that will be the kind of puzzle to solve. But on the short term, I think the bounce can continue. Now, Eric, let's move on to crude oil. What a move. What are your thoughts here?
Well, Patrick, OPEC is signaling that they can live with lower oil prices, and they're not going to pursue any aggressive hiking campaigns in order to try to stave them off. Okay, that opens up a whole hornet's nest of follow-on questions. Why are Saudi Arabia and OPEC suddenly taking this change of policy? Is this a concession that they're making to President Trump? And if so, what's the quid pro quo? That's the biggest question on my mind. And if this is not something that they're doing for President Trump's benefit, okay, why would they suddenly be wanting or welcoming lower oil prices? You ready for my grand fundamental brilliance on this? I have no clue, but I do know who to ask, which is Dr. Anas Al-Haji. I have his WhatsApp. I'm going to do my best to get a full briefing on what's going on. He's one of the very first people that the Saudis will tell whatever messaging they want the West to hear about this event. So I'll try to get an update from Dr. Anas, and we'll get that before next week's show. Our producers have also reached out to try to get him back on for a MacroVoices interview as well. For now, my early instinct is that this is a very important signal that we need to dig beneath the surface to figure out what the important reveal is likely to be. Is that a quid pro quo? If so, what's the quid pro quo? What is the Trump administration giving up in order to get lower oil prices? What deal did they make with MBS? Now, I'm just making guesses, but my friend Dr. Anas Al-Haji has personal context both in OPEC and in Saudi royalty. So he'll get to the bottom of this, and I'll get full details for you for next week's podcast.
Well, Eric, the crude oil price action is incredibly weak. It's one of the ugliest charts out there in the markets. All the rallies are failing below fib zone, staying below its moving average. What were previous highs act as overhead resistance, very quick to roll over. On a closing basis, we're already breaking to a lower low. A number of the different measured moves all leave the vulnerability for us to temporarily trade down even as low as $50. And I want to say temporarily because I'm not so sure that we would stay down there. You know, there's a lot of reasons why I think oil can be back in the 60s and trading within these ranges over any intermediate period of time. What is the short-term path and the trading risks on the short term? Definitely to the downside, definitely vulnerabilities all the way down towards $50 on there. And you don't want to stand in this thing's way until we see where the bottoms really start to get banged out. All right, Eric, let's move on, though, to gold.
Patrick, I remain cautiously bullish for much higher gold prices before we eventually reach a final top for this cycle. But as I've said before, we're into the treacherous parabolic phase now, where it's easy to lose your shirt if you get the timing of the cycles wrong. So I'm frankly most hopeful for more consolidation and less upside price action. Let's shake off that last parabolic thrust up and get this bull market back into a healthy setup for a long and sustained rise without a blow-off top reversing the major trend, which is the fear that I've had here. So I'm really hoping that we're beginning a consolidation phase that's going to allow us to shake off these elevated RSI and stochastic levels and get this market set up for a sustained move to higher numbers.
Well, as we're recording this, we're getting a 70-plus point down day as we slowly heading down towards 3,200 on gold. This is actually a really important point here around 3,200 for me. It's a Fibonacci retracement zone. That 50-day moving average is slowly creeping up. This is the typical buy zone in bull trends. And this is why this is such an important moment. We still haven't seen whether the buy on dip trader is going to come in here, but that's certainly the thing to watch in the next 2 or 3 trading sessions. Will 3,200 be defended? Will the buy and dip traders reverse this and get this back above 3,300 in a short window of time? This is important because if we see 3,200 hold and we see we're back above 3,300 next week sometime, then the window opens right upside to the upside again for a push up to 3,500, 3,600 on the upside. And that's the bull case. Now, if 3,200 doesn't hold, then in my mind, that indicates to me that gold has entered some sort of a more intermediate consolidation that could take 2 or even 3 months. Maybe we could see numbers as low as 3,000 in a consolidation. But I'm not going to build the kind of analog for that kind of a correction yet. My first approach here is that the 3,200 will be bought on dip. So we're going to watch closely whether or not this support line holds in here. All right, Eric, let's dive into uranium here.
Well, Patrick, we've seen plenty of false bottom calls in this treacherous market in terms of investor sentiment, but several uranium issues moved and closed above their 50-day moving averages this past week, and that was for the first time in more than 5 months. So at a minimum, we're seeing at least beginning signs that the bottom might be in and that a new bull market might be beginning. But I want to defer to you, Patrick, as the technical analysis guru in the house. I know that you've cautioned many times that while the fundamentals might be impeccable, there just wasn't a valid technical case to buy uranium miners when the prevailing trend was clearly and obviously down. Patrick, what technical signals do you need to see from the uranium market to tell you not only that the bottom might finally be in, but also that there's enough upside momentum and technical accumulation patterns that are forming and starting to kick in this market, which would make you feel like, okay, now it's finally time to load up and start buying for the next major bull run in uranium?
That's a great question, Eric. So let's start off on page 7 where I have the Sprott Physical Uranium Trust. And what we see here is that this is the first time it's attempting to close above its 50-day moving average since rolling over back in late fourth quarter of last year. Now, what we want to watch is whether or not we see signs of a basing or bottoming formation, all dips being bought, it beating key technical hurdles. Want to see that there's some new accumulation occurring and a good basing formation developing. And on page 8, I have the chart of the global X uranium ETF, the URA. And from a technical perspective, I always find it a very good positive initial sign when a rally occurs that wipes out the entire last wave of selling. And so when we look in the last few days of March into April, when the URA had its big drop from $25 down towards $20, we've now seen that entire sell-off completely reversed. Now, what typically then you want to see from a trading perspective is that when we pause here and correct, that we don't see it make lower lows. We want to see that a new accumulation has begun and that the trend, the big downtrend that's been in place now for 6 months has in some way or another reversed. And that's something that I think will take deep into the month of May for us to sort. One way or another, there was a very ugly sell sequence, and it now is taking a break and starting to consolidate. So this is some initial positive signs that will make the second quarter pretty interesting here in the uranium space. All right, Eric, I want to wrap up by on page 9 looking at the 3-month SOFR futures. I particularly wanted to go out to December 2026, more than a year and a half out. And this is a great place to look at what the market is anticipating for short-term rates to be, such as the Fed funds, at that point in the future. A great way of kind of gauging how many rate cuts are coming in. And so what's interesting to me here is that going back even 2-3 years, we've seen this kind of 3% level around the 97 level act as a pretty significant overhead resistance. But we're now in a situation where recession risks are rising, and the idea that the Fed may be engaged in policy error that could result in the market at some point having to price in more rate cuts when they are forced to give a dovish tilt. This is a really interesting resistance level to watch, especially considering we're going into the FOMC meeting. If we see that the tone from Powell has shifted and the markets start to price in a more dovish Fed, we could see this potentially even break this 3-year resistance line and potentially make a move even toward 98. Now, will we see that? I mean, there's a lot of things that need to happen for that to play out, but that's one of the technical things I'm watching, and is certainly going to continue to feed the recession risks if that was to happen.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.